Hi everyone, welcome back to the US individual taxation classes enroll agent part 1. This is in continuation of chapter 2, which is income and assets, right? So in this particular video I'll be covering two topics. The first one is basis of stock after the stock dividend and stock split. Then we'll be starting disposition of assets. So disposition of assets is slightly bigger topic. So you have one more video coming after this. So let's dive into to understand more in detail about these topics. Okay, so we are starting with 2.10, which is basis of stock after stock dividend or stock split. So there are two categories. One is stock dividend, the another is stock split. Stock dividend mean instead of cash, company is giving you new fresh share. And stock split is, that means you already have some share, which is like in the earlier example we have discussed, and the number of shares are changing. Instead of one, you are getting 2 share or 10 share. For example, you have $100 each share. Now the company is doing the restructuring, right? In the restructuring, they are making it stock split to 1:10. So instead of one share of $100 each, you are giving back to the company, and company is returning you 10 share of $10 each. So that is called stock split. Let's understand. Stock dividend is a payment to the shareholder that consists of additional share rather than cash. So every year, company is supposed to give some dividend to the shareholder, right, from their profit. So instead of giving the dividend in cash, so company has decided to give you the shares, right? So that share which you are receiving in lieu of dividend is called stock dividend, right? And that stock dividend are generally on the fair market value on the date of dividend is declared, right? Second is stock split, which we have discussed. Stock is divided and increase the number of shares in the company, but value remains same. So in case of stock dividend, the value will also change and number of stock will also change. But in case of stock split, only the number of shares change, but value does not change. Make sense? For example, after a 2-for-1 split, each investor will own double the number of share and each share will be worth half as much. So for example, before stock split, you have one share of $10 each, right? And that has a market value, let's assume $100 each, right? After the stock split, you will get two share of $5 each, and their market value will be $50 each. So total value remain the same, $100, but number of shares will change and value per share will also change. Make sense?
Sir,
Yes, ma'am.
actually my mic stopped working, so I joined it again, sir. Sir, could you please go back to the questions? I had it out.
Which one?
Sir, yes, sir, second one, sir. Sir, I want to ask, like, only the depreciating asset we have to consider in this question, like, so I had land is depreciating or non-depreciating? The land will be, the building is depreciating, I know.
Building is depreciable asset. Land is never a depreciable asset.
And taxes, sir, like,
Taxes are expenses.
okay, sir, like I
Taxes,
just,
you pay property tax, house tax, right? So those all are your annual expenditure.
okay, okay.
Those are not part of your property, plant and equipment. But if you are paying stamp duty to purchase the land, right, that is part of capital expenditure.
Okay, sir.
So we are on stock dividend and stock split. Stock dividend and stock splits increase the number of share, however reduce the value per share. These transactions are generally non-taxable. However, like any change in the number of share an individual own and the basis of those will also be changed. So basis of original share is divided with the post-event number of share. So your base will be divided by the post-event number of share to give you the market value of the each share. So for example, like we were discussing same example again, let's assume you have one share of $10 of which the market value is 100 and company has called it for the stock split 1:2. So company will give you $5 each, 2 shares, right? Now the value of each share would be $50 instead of $100 because $100 is split into 2 shares. Make sense?
Yes, sir.
So let's try a question. SSB Tax Corporation declared and distributed a dividend, stock dividend of 1 share for each 4 share. That means the individual who is holding 4 shares will get one more additional share now. D had 100 shares and as a result of the stock dividend, he received 25 additional shares, right? So how much is the additional share he is receiving? 25, 1:4, right? 100 divided by 4. Have you understood question?
Yes,
How this
sir.
25 is come? Rajat, Mayank? Okay. So first point is the stock dividend is taxable for the fair market value of the share received on the date of issue. Second is stock dividend is taxable since the stockholder received stock in company in lieu of cash. Third is D purchased his 100 share of stock for $5 per share. The result of the stock dividend, he may adjust the basis of 125 shares to $4 a share. Fourth, this is non-taxable because it is return of capital. Which option is right out of these four?
For option third.
Option third, why?
Market value will remain same.
Mm-hmm.
And the number of shares increase, it doesn't matter.
Yeah, Rajat, Mayank, what's your thought? Are you guys here?
Still thinking, sir.
So let's look at first option. Stock dividend is taxable for fair market value of the share received on the date of issue. Would that statement, is that statement right? Mayank, Rajat? Or shall I just keep on moving? You guys are not responding at all. What happened, Mayank, Rajat?
I'm thinking, sir. I'm thinking. I'm not able to get the. It seems a bit not clarified from my side, sir. Like I'm not able to get the call of the question.
No, call of the question is out of these four statements, which statement is right?
That's it.
Not able to get it? Mayank, Rajat, Vivek? So this guy Don, he has purchased 100 shares, and company has issued a stock dividend, 1 share for each 4 share, right? That means he has received 25 additional share without paying any additional money, right? So now he has 125 share instead of 100 share, right? So that 100 share value for which he has purchased is now the value or the cost of 125 shares, right? So he need to adjust that basis. That's what the call of the question is. Make sense, Mayank, Vivek?
उसकी वैल्यू बढ़ नहीं जाएगी वो जो $25 को हो रहा
No,
है
value will increase, but the cost remains same. Right? You have paid, for example, you have purchased 100 share of $10 each. So you have paid $1,000 for 100 share. Now the company has given you additional 25 share, but without any additional cost. So the cost remains same, 1,000, but number of share is 125 now. Right? So 1,000 divided by 125 would be the per share value cost to you. That's a base to you. That's what it means. Make sense?
I have one question like, sir, stock dividend या stock splits के अंदर there is some adjustment regarding like the कुछ expenses हो तो सर इसका भी adjusted basis होगा फिर?
No, this in case of stock dividend, there's no expense to you.
Okay.
I'll show you by an example really quick. So for example, shares, rate, value. Or you can say the basis in your account. So you have 100 shares which you have purchased for $10 each, and the value is this multiplied by this. Now you got additional 25 shares and you have paid nothing. So value remain, sorry, and you have paid nothing. So zero cost. So now you have total number of shares 125 and total value is 1,000. So earlier you are having per share was $10, but now you have per share at $8. Make sense?
Sir, why that goes to 8, sir?
Sorry?
Why the rate got to 8, sir?
Because now you have 125 shares, but the cost which you have incurred is still 1,000. You have not incurred any additional cost to purchase them.
So basically we will go for the second option, that is 125 at 8.
Yes, that's your costing. That's your basis.
Yes, sir.
Make sense?
Yes, sir.
Vivek?
yes clear
Okay. So next topic is disposition of assets. So disposition of assets may result into a taxable gain or loss, or it may result into a non-taxable gain or loss, or it may result into deferment of gain also, right? So when the gain or loss are taxable, so gain or losses which are not specifically excluded or deferred are all taxable gain or loss. So we need to understand second box and third box to reach to the first box basically, right? Whatever is not covered in the non-taxable gain or loss or deferred gain and loss, all the gain and loss relating to that are taxable gain and loss. So let's understand the box number 2, which is non-taxable gain and loss. When gain or losses are not taxable. First one is losses on sale or exchange or condemnation of personal use assets are not recognized. So if you have any personal asset, like for example, if you have your mobile, right, you purchase it for $1,000 and after 1 year you are selling it for $100. So you cannot recognize that $900 loss into your taxable income because that's your personal asset. Make sense? If you have a refrigerator, you purchase that refrigerator for, let's say, $2,000, and after a year, you're planning to dispose of that refrigerator for $500. So you cannot book that $1,500 loss to your taxable income, right? So personal properties are not considered as taxable gain or loss for adjustment of taxable gain or loss. Make sense? Yes, no?
Yes.
Right? So is it making sense? Your personal property, or you can say your personal belongingness, loss on them should not be considered as a taxable loss. Is that statement looks good to everyone?
So it is a personal loss then.
Yes, it's a personal loss. Absolutely true.
Okay.
Right. Second is loss on sale of income producing asset to related party are not recognized. However, if related party further sale to unrelated party, they can take a benefit of loss to consider the loss in a basis of assets. Which example I think Shubham has shared the question. So related to the related party. So here what they are saying, for example, Rajat and Mayank are related party, and Rajat has, let's say, an automobile, a car, which he has purchased for $20,000, and after a month he has sold that car to Mayank for $5,000, right? So here, can Rajat book that loss of $15,000? The answer is no. But let's assume Mayank sell that car in future after a month to Vivek, who is unrelated party to Rajat and Mayank, for, let's say, $12,000. So in that case of scenario, the base will be considered as the base of Rajat, which is $20,000 at which Rajat has purchased. And now the sale price is $12,000. So this 8,000 loss, which is an actual loss, can be considered. Make sense?
Yes, sir.
Everyone? Mayank, Vivek?
Yes, sir.
ये जो सर लॉस होगा उसका बेनिफिट के वो कौन लिख सकता है उसमें रजत लिखेंगे या वो लिखेंगे
Mayank.
ओके
Very good question. Mayank. Yeah. So next is sale or exchange of principal residence except up to $250,000 for individual and $500,000 for joint return. So if you are selling your personal residence, so there are certain exemption available for an individual filing single return up to $250,000, married filing joint return up to $500,000. So till that extent, loss are income is not taxable, gain is not taxable. Last one is qualified small business stock exemption. So this comes under section 1244, which we will be discussing today in detail. There are certain companies which is considered as a small business. So anyone who has purchased their share directly from the company, and then they are holding that share for more than 5 years, and after that they are selling and generating certain gain, so there are certain exemption to it. So we'll be discussing in detail section 1244. It is qualified small business stock. So these are, you can say, losses which are not allowed or gains which are exempt. Third box is deferred gain. Deferred gain, like we have already discussed about installment sale, right? In the installment sale, your gain will be recognized based on the collection. So your gross profit ratio multiplied by the collection for the respective year. To that extent, the gain will be recognized and the rest of the gain will be deferred. Same is the case of replacement property. So if you are holding a property and in future you are replacing that property, if you are buying the similar type of property, then you can defer certain gain up to 3 years. We'll be discussing that also in detail. Third is tax-free exchange. So there are certain exchange which is specifically considered as a tax-free exchange. If you are making such exchange, so any gain or loss generated on such exchange are tax-free. Involuntarily conversion. So involuntarily conversion may be on account of you can say condemnation. That means like government is seizing some property, right? Or any casualty or theft, right? In that case of scenario also, there are certain deferment of gain allowed. So we'll be discussing that also in detail. And last one is the wash sale. So if nothing's fall under the deferred gain or non-taxable gain or loss, any such transaction which is resulting into any gain or loss will be considered in the very first box, which is called taxable gain. So disposition of asset may result into taxable gain or loss, non-taxable gain or loss, or deferred gain, right? So these are the three possibility on account of sale of any asset or disposition of any asset. Make sense?
Sir,
Mm-hmm.
I have a doubt, sir. Sir, like in the non-taxable gain or loss, there is third point, sale or exchange of principal residence. So sir, it's for the individual and the joint return, sir. So like it's basically includes the sale or exchange of like the property rights.
Yes, your
So
personal residence. Yes.
yes, sir. So like we studied the five heads, sir, like in the first class, like widower, joint return,
Mm.
individual.
Mm-hmm.
So basically for the individual or for all the categories, it's two
No,
lakh.
or you can say single married. Like if you are unmarried, then you are single, or if you are married filing single, then 250,000. If you are married filing jointly, it is 500,000. If you are filing head of the household, then 250,000. Or if you are filing widower but you are claiming married filing jointly, then up to $500,000.
Okay, okay.
Very good question. Okay, so now let's understand first point, sale of personal residence. Sale of personal residence, or you can say the principal residence. So two things we'll be understanding here. One is, like how to calculate the gain or when to calculate the gain. And second is what all exclusions are available to those capital gain and how you can avail those exclusion. If you look at left-hand box, the principal residence. What is the principal residence? First, let's understand that because the exemption is being applicable only and only to the principal residence, not to any other residence. So first, let's understand what is principal residence and the requirement of a principal residence. So the person who owned and occupied at least 2 out of 5 years by the taxpayer. So the residence is called principal residence when it is being owned and occupied for 2 out of the 5 years, 5 tax years, right? Make sense? Simple. First point is simple, digestible.
Yes, sir.
Yes, sir.
So they are saying you should be owning or occupying both. Owning, that means it should be in your name, right? And you are occupying that also from 2 out of the 5 previous years. Second is in case of married filing jointly, either spouse, that means either husband or wife, should satisfy the ownership requirement. So ownership can be in the name of husband or can be in the name of wife or can be of both. But both the spouse must meet an occupancy requirement. That means 2 out of the 5 years, both of them live together in that home. Then only that home they can claim exemption under the married filing jointly return. Right? In case of divorce degree or separation instrument, an individual is treated as using the property as his or her principal residence during any period of ownership while the individual spouse or the former spouse is granted to use the property. Let me, yeah, Mayank, you're saying something?
Right. Sorry.
Okay. So in case of divorce decree, an individual is treated as using the property as his or her principal residence during any period of ownership, while the individual spouse or former spouse is granted use of the property. It means, for example, there is a husband and wife, and they are living in a home. One person, let's assume like husband is owning that property, and after the divorce decree, that property has been transferred to the wife, right? So in that case of scenario, the wife would be avail the benefit of owning as well, because before the separation, they both the husband was owning the property and the same title has been transferred to her. So in that case of scenario, the owning requirement is also being satisfied by the wife if she get in the divorce decree that particular property. Make sense? Vivek, Mayank?
Yes, clear, sir.
Okay. So now we understood what is the principal residence requirement. Now let's understand what are the exclusion of capital gain from taxes. If you are an individual, that means single, or married filing separately, or head of the household, right? So maximum exemption or maximum exclusion of the capital gain is $250,000. If you are filing jointly, married filing jointly, or the widower who is availing the benefit of married filing jointly, they can take the benefit up to $500,000. Right? This exclusion may be used only once in every 2 years. So you cannot use this exclusion every year. You can use this exclusion only once in 2 years. Right? When one spouse has used the exclusion up to $250,000 within past 2 years, an eligible taxpayer may still exclude $250,000 on their joint return. For example, Mr. X got married with Miss X. Let's assume in 2022. In 2021, before they get married, Miss X, she has sold a principal resident and taken the benefit of $250,000 in her individual tax return. Now in 2022, they both got married, right? And in this year, they have sold Mr. X homes, right? Can they avail the benefit of $500,000? The answer is no. They can avail remaining $250,000 benefit because $250,000 already being availed by the one spouse. Make sense?
Yes.
जैसे कि इसमें ये लिखा हुआ है, the exclusion may be used only once every 2 years.
Yes.
जैसे प्रिंसिपल रेजिडेंस की एक्सक्लूजन होती है 250,000 पे, अगर जो सिंगल फाइलिंग कर रहे हैं तो सर ये टाइम में एक बार ही नहीं होता कि जैसे कि हम
No, every year you cannot be eligible. No, you should be at least 2 out of the 5 year you'll be living there. So that's practically not possible.
Okay.
That's practically not possible. At least 2 years you should be staying in that place.
Okay, sir. Okay.
When husband and wife each sells a principal residence, they each are eligible to exclude $250,000. They can exclude in joint return and their individual return. So if they are filing individual return, then also they can claim 250 individual, or if they are filing joint return, they can claim up to $500,000. In case of death of a spouse, surviving spouse can exclude up to $500,000, which we were discussing in case of qualified widower from the sale of the principal residence if the sale is within 2 years of the death. So within 2 years, he or she can claim as a qualified widower status, right? If the person is claiming qualified widower status then only $500,000 up to exemption is available. In case of change in employment for any unforeseen circumstances like medical emergency, if the owner and occupancy test are not met, then pro rata exclusion is available. For example, you have purchased a home. Let's assume you are living in California and you got a new job in Michigan state, which is extremely cold winter, and you have purchased the home over there, but once you move to the Michigan, you are feeling it difficult to survive and you are having some medical issue, and on the ground of medical issue you have taken your transfer back to California, right? In that case of scenario, you can avail the benefit for the proportionate period, because only in case of medical ground, medical emergency, right? For example, you are owning 15 months out of the 24 month, or you are living 15 months over there out of 24 month period. So you can take an exemption up to 15 by 24 multiplied by the gain. So you can take pro rata basis of exemption from the gain. Make sense?
Yes, sir.
Any doubt here? Sale or exchange of principal residence? So far so good?
Yes, sir.
Okay. So next topic is gain or loss on sale or exchange of qualified small business stock. So what is qualified small business stock? Let's first understand that. Then we understand how much is the exclusion on those gain. And then we understand allowance of losses under section 1244. So first, if you look at left hand side, the very first column, qualify small businesses under section 1202, right? So 12th February, you can remember easily, or February 12th, something like that, right? So qualify small business stocks. First, let's understand what is a qualified small business. In the United States of America, C corporation with 50 million or less capital, 50 million or less capital of C corporation are considered as a qualified small businesses if the following conditions are met. First one is if the C corporation has increased capital from 50 million after those new stocks are not qualified. That means, for example, there is a C corporation called XYZ C corporation, right? Let me draw an example for you. So let's assume there is a company called XYZ C Corp. They have formed formation in 2015. So they have formed a company in 2015. And they have like share capital of, let's say, $20 million, $30 million. Number of shares. Let's assume they have $10 each. So how many number of shares? 3 million, right? And here, let's assume you are Mr. A. And Mr. A has purchased, let's say, 500,000 shares. And Mr. A has purchased $500,000 share at the rate of, let's assume, 10 each. How much is the value of share? 5 million. Are you guys with me?
Yes.
So now
Yes.
let's understand. So United States C corporation with 50 million or less capital can be considered as a qualified small businesses. If C corporation increase capital from 50 million, after those new stocks are not qualified. So let's assume in 2020 they have increased the share capital to by 20 million. So Mr. A has purchased from the original lot and now they have increased further $20 million, right? And in financial year 2022, they have further increased share capital by 50 million. So let's keep these numbers in mind and let's understand. So what they're saying, if C corporation increase the capital from 50 million, after those new stocks are not qualified. So till what extent the stocks are qualified stock? 30 million plus 20 million. Till this, the stocks are qualified stock. But this stock they have issued after that would not be considered as a qualified stock.
So only 20 million will be considered, sir, or 30 million?
No, 20 plus 30.
20 plus 20. So basically it will be 50, sir.
Yes, that's what they say is up to 50 million, it's qualified stock. But after that, it's not qualified.
More than 50 million, right?
Yes, more than 50 million is not qualified, right?
Okay, sir.
Stock must have been directly acquired as original issue or via gift or inheritance from the original acquirer. So you can avail this exemption only when you have originally purchased. That means this original share of 30 million or this 20 million. From these share, you are the first purchaser, not the trader, right? So if you have originally purchased from the company, from the first $50 million share, right? So only those shares are considered as a qualified share. It should not be from the open market or from the repurchase. Make sense? It should not be like Mr. A has purchased $5 million value share and then he has sold to Mr. B and you are purchasing from Mr. B. Then this share is not considered as a qualified share for you. This share will be considered as a qualified share only and only for Mr. A who has directly purchased from the company. Make sense?
Yes, sir. Yes, sir.
Rajat? Okay. Next is must hold for more than 5 years. So now Mr. A has purchased in 2015. Now he is selling in 2023. Let's assume he is selling 100,000 shares at the rate of, let's say, 50 per share. How much is the value? 5 million. Are you guys with me?
Yes, sir.
So 50 lakh, 5 million, right? So now in 2023 he is selling 100,000 share which he has purchased in 2015 from the original lot from the company at $10 per share. So must hold for a period of more than 5 years. If the holding period is less than 5 years, you cannot consider that as a qualified business stock. At least 80% value of the corporate asset must be in active use of the business of C corporation. So let's assume the company has this 30 million share capital and they have assets They have purchased assets of $25 million. Let's assume. Rest, let's say they have invested in working capital, and here let's say they have purchased $15 million. So how much is the total asset they have? 25 plus $15 million. Let's assume $40 million asset they have. So what is assets? Property, plant and equipments, right? Are you guys with me?
Yes.
What is assets? Property, plant and equipment. So what it says, out of those 40 million worth of asset, right? More than 80% should be in active use for the business purpose. That means this multiply by 80%. At least $32 million worth asset must be used for the active business purpose. That means they can have this minus this up to $8 million property which is not in active use. Not in active use means like from there they are generating rental revenue, right? They have taken a property which they have given on lease but not using for business purpose, right? So that is a passive usage, right? Makes sense? They have purchased fixed deposit on which they are generating interest, or they have purchased the share of any company on which they are generating dividend, right? But not actively using in the business. Make sense? What does active mean?
Yes, sir.
Sir, is it necessary that it has to generate some income, or
Yes.
can it be, just like, for example, land, but they have not built anything on it. It's just uh, like an investment purpose.
Yeah, that's what I'm saying. If it is just for investment purpose, let's say you have purchased a building and you have given it on the rent. So it is a passive usage, right? You are not actively using it for the business purpose. But if you have purchased a land, constructed a building, and now using that building for office purpose, for your business purpose, then it is active use. But if you are giving it to the third party on a rent, then it is not for your business purpose unless and until you are in rental business. Make sense?
Okay.
Any other doubt?
No, sir.
Okay. So at least 80% value of the corporate asset must be active use for the business purpose. That means they are using more than 80% of their asset for the business purpose only. C corporation must provide service in a eligible sector. So the company should not be working for any sector which is not eligible to consider as a small business. What are those areas which is not considered as a qualified small business? Is personal services, right? For example, like saloon, doctor, CPA, lawyer, right? Banking, financing, leasing, hospitality, healthcare, farming, mining are not eligible, right? These all comes under not eligible category of services. But other than this, all category of services or production is being considered in the eligible qualified small business. So what all things you need to keep in mind when you are evaluating whether the company is a qualified small business or not, or whether the share you are holding of any company is being eligible for section 1202 or exemption under section 1244. First thing is the share capital of that company should be less than 50 million at the time when you have purchased the share, right? If you have purchased the share from the lot which is after $50 million, then you are completely not eligible for it, right? You are only and only eligible when you have purchased directly from the company when their share capital is less than $50 million. Second thing is, as and when they increase their share capital up to $50 million, all shares are being eligible. But as and when it goes beyond, and from that, if you have purchased, then those shares are not eligible. Second is, stock must have been directly acquired. So you should have been purchased directly from the company, not from the broker, not from the mediator, or not from any third party. And you must be holding those shares for at least a period of 5 years, and that company's asset, 80% of their asset must be in active business use. So if all these conditions satisfy, then the share which you have in hand can be considered for the exclusion of gain under section 1244 of the Pathway Act. Right? What are the exclusions available for the gain under the Path Act 2017? 100% exclusion of the gain. So now we are in second box, right? We are done with the first box, which is qualifying small business stock. Now let's understand what is the exclusion available. Exclusion is 100% of the gain from taxable income or alternate minimum tax or 3.8% of the Obama tax. So any category of tax, you will get 100% exclusion. If qualified business stock held for a period of more than 5 years. So if you are meeting those qualified business stock category and you are selling those qualified stock and generating any capital gain, onto those capital gain up to 100% tax is being exempt. Whether it's your direct tax, your alternate minimum tax, or your 3.8% Obama tax, all are being excluded. Limitation for the exclusion. What are the limitations for the exclusion? Greater of the following eligible gain from any one corporate issuer: 10 million for married filing jointly, or 5 million for married filing separately or for the single, right? So maximum exemption is 10 million for married filing jointly and 5 million for single. Less eligible gain excluded in prior year from the same corporate. For example, let's come back here. In this example, if you have seen in 2023, Mr. A has share $100,000 share, 100,000 shares of $50 each for 5 million, right? How much is the gain he has generated here? 5 million minus, what is the cost? What is the cost? Are you guys with me? And how much amount he has purchased 100,000 share?
$10.
Hmm?
$10 each.
Basically 4 lakh million, sir. 4 lakh million, sir.
Yeah. So this is the costing. How much is the gain? $4 million. Are you guys with me?
Yes, sir.
Yes, sir.
So in 2023, the gain is $4 million, right? And let's assume in 2023, he has claimed this $4 million gain. Now, Mr. A in 24 is again selling 100 shares. Now this time he is selling for what amount? Let's assume 70 each. So what is the value? How much will be the value? 7 million. Are you guys with me?
Yes, sir.
Yes.
$7 million.
$7 million. And what is the cost?
10 million.
10 million. No, 1 million.
1
And
million.
what is the gain?
6 million.
6 million.
4 million.
6
6
million.
million.
Right. So in this 2024, how much gain he can claim? If he is married filing single, then 5 million at the max, but minus eligible gain excluded in prior year. So if he is filing as an individual, or you can say single, then how much he can claim? 500,000, $5 million
Minus 4 million.
minus previous year, he has claimed 4 million. So maximum in 2024, he can claim how much? $1 million out of this $6 million. Make sense? Yes, no.
Yes, sir.
And
Yes, sir.
if is married filing jointly, then how much? 10 million minus 4 million, so 6 million. So this entire gain he can consider for eligible. Yes, no,
Yes, sir.
Yes.
right? So this is what it means is 10 million for married filing jointly, 5 million for individual, less any gain which is being already considered in the prior year, or 10 times of the adjusted basis, or 10 times of the adjusted basis. What is adjusted basis? $10 per share, right? So 10 times of adjusted basis. For this, it will be this multiplied by 10. And for this also to this, up to $1 million, $10 million, sorry. Make sense? Whichever is lower. Whichever is lower. So greater of the following eligible gain for any one of the corporate users. So whichever is greater, sorry. So $10 million, $5 million, or 10 times of the adjusted basis, whichever is higher. But you will be reducing the eligible gain which is being excluded in previous year. Make sense? Shubham?
Yes, sir.
This gain will be tax excluded from the tax.
Yes. Up to 10 million or up to 5 million as the case may be.
ये तो बहुत बढ़िया बात है.
Yep. Individual shareholder should have purchased the stock directly from the corporation. That's mandatory requirement. And losses in excess of maximum can then be deducted as a capital loss. So capital losses are generally, capital gain are generally taxed at lower rate, right? So that additional benefit, even after the exemption, that it is, you can claim that loss against the capital gain. Clear? Second box about the exclusion. Let's jump into the third box, which is allowance of losses under section 1244. So in the second box, we discuss about gains. Now in third box, we are discussing in case of losses, right? Losses from sale of share of small domestic corporation to be deducted as ordinary losses. So this is additional benefit you're getting. So the government wish you or encourage individuals to invest in the small businesses so that they can avail maximum tax benefit. So in case of loss, then rather than considering that as a capital loss, you can consider that as a business loss, ordinary business loss, and reduce your business income, which will be taxed at 25%. So you'll be saving at higher tax rate. Make sense?
Yes, sir.
So losses from sale of share of small domestic corporation to be deducted as ordinary losses instead of capital loss up to an annual max of $50,000 for $50,000 per year for individual and $100,000 for a joint return. Right? If the corporation aggregate capital must not have exceeded $1 million when stock was issued, that means when you have originally purchased the share, at that point of time, the total share capital issued, one second, just give me a second. Hello. Sorry. So in case of losses for an individual filing single or separate return, $50,000, or for married filing jointly up to $100,000, but you need to meet with certain conditions. The first one is the corporation aggregate capital must not have exceeded $1 million when the stock was issued. So when you have purchased the stock, at that point of time, the total share capital of the company should be less than $1 million. Second, corporation must not derive more than 50% of its income from passive investment. What is passive investment? Investment in shares, investment in bonds, investment in mutual fund, investment in fixed deposit. So the company must have more than 50% its active income, not the passive income. Third is shareholder must have paid for the stock and not receive it as a compensation like ESOP. So you have purchased that stock. It should not be like you have received that stock as a compensation in case of ESOP. Fourth is individual shareholder should have purchased the stock directly from the company, not through the broker or not under the reseller market. Last one is losses in excess of maximum can then be deducted as a capital losses. Any doubt here on third box? When you can consider the loss as ordinary loss and adjust against the ordinary income, which is being taxed at higher rate, so you can avail the higher tax benefit of these capital losses. So first one is the aggregate capital must be less than $1 million when you have purchased the share, and corporation should have more than 50% income from the passive active activities, right? And the shareholder must have paid for the stock and not got the stock as a ESOP or as a compensation. An individual shareholder should have purchased the stock directly from the company, and the losses in excess of the maximum can then be deducted as a capital losses up to $50,000 for individual, married filing jointly up to $100,000. If you have loss more than that, that loss also you can adjust against the capital loss, not the ordinary loss. Any doubt? Mayank, Vivek? It looks complex. Huh?
A
Hello?
little.
I know it has a couple of rules, but I tried to summarize in a very short form and in very parallel form so that complete picture would be in front of you at one page.
तो
if you
सर
go
ये
by
जो ये क्वेश्चन है 1231, 1244, 1250, 1245, 291 इसके ऊपर से क्वेश्चन आते हैं.
yes, these couple of section you should remember. So like 1231, 1244, 1245, 1250, 291, 1202. So these are like the section which I'm specifically mentioning in the notes are actually important sections for you to remember. Vivek, Rajat, Sachin.
Yes, sir. Yes, sir.
So far so good?
Yes, sir.
Okay, let's do a practical question. Shannon and Dan Smith, wife and husband, purchased 1244 stock in 2021. Which of the following statement is correct? So husband and wife, they purchased small business stock in 2021. So which of the following statement is correct? If the stock become worthless, they can claim an ordinary loss limited to $50,000 individually, $100,000 together on a joint return per year. Second, if they incurred a gain on section 1244 stock, they should treat it as ordinary gain. Third, if the loss is $60,000 and Shannon does not have any other loss, Dan can only deduct $50,000 as ordinary loss in the joint return. If they incurred a loss on section 1244 stock, they can deduct the loss as a capital loss rather than as ordinary loss. Let's go one by one. First statement, if the stock become worthless, that means you have purchased a stock and now the market value has gone down to those, right? Can you claim the loss? The answer is no, because gain and loss will be recognized only when you are actually selling those stocks, right? So first answer is incorrect, right? Shubham, Vivek, Mayank, are you guys with me?
Yes, sir.
Second is, if they incurred a gain on section 1244, they should treat that as ordinary gain. No, if there is a gain under section 1244, it should be treated as a capital gain, right? So this statement is also incorrect. Third is, if the loss is $60,000 and Shannon does not have any other loss, Dan can only deduct 50,000 as the ordinary loss on a joint return. No, in a joint return, they will get $100,000, right? Hence, this third statement is also incorrect. If they incurred a loss on section 1244 stock, they can deduct the loss as a capital loss rather than ordinary loss. So that statement is right, that we have just discussed. Make sense? Shall I go up?
Yes, sir, please. Yes.
Yeah. Just take a quick read of this. Just take a quick self-read of this page to digest the information. Are you guys reading it?
Yes, sir.
Any doubt or anything you need more clarification? Rajat, Mayank, Vivek, Sachin.
Yes, sir. Yes, sir.
Still reading, sir.
Like sir, 2-3 times to read, sir.
No worries, take your time. It will be good if you clarify the doubt in class. Shall I go down?
Yes, sir.
Maybe shall I slightly reduce the size?
Sir, please move up a bit, sir.
Now it's better.
Yeah, sir, like it's the heading, sir.
Headings.
I'm not able to. Oh yes, sir. I'm better. Yes, sir. Fine. Sir.
Done, everyone?
Yes, sir.
Rajat? Vivek?
Yes, sir. Yes, sir.
Any doubt? Any doubt? Or it's clear? Rajat? Sachin?
Sir, can you scroll up?
Try to read like point by point, like then it will be easy for you to digest. If you go into the book, so it's scattered all over a couple of pages. I try to build it in a one page so that in a one go you have like complete picture. Done, Rajat?
Yes, sir.
Okay. So any doubt before we jump into the new topic? Yes, no?
No, sir.
Everyone okay?
Yeah.
Okay. So next is deferred capital gain. So in the deferred capital gain, if you see here in the disposition, so we are in this bucket, deferred capital gain. Installment sale, replacement property, tax-free exchange, involuntary conversion, and wash sale. So first, we are understanding the installment sale. So this I think we have already covered earlier also, right? This is, I think we have covered this installment sale. Yes or no? Mayank? Rajat?
I don't remember this.
You don't
No,
remember? Rajat, what about
No,
you?
sir. No.
no,
Not
sir.
covered?
I don't think so, sir.
Okay, so might be in like FAR class I have covered or CPA classes. So installment sale. So in the installment sale, generally we like normally whenever we make the sales, so we recognize the revenue as well as we recognize the profit upfront, right? But in case of installment sale, this is exception to the general rule, right? Where we defer the gross profit, where we defer the profit only to the extent of the collection receipt. Generally, like when you make a sales, what is the journal entry we make? If, for example,
Cash to sales.
that's too quick. 1 second. So, for example, generally, let's assume you are a car dealer, right? And you are selling car. So let's assume you have sold a car to a company on credit. So what will be the journal entry for the sales? Account receivable, debit to sales. Yes, no? Are you guys with me? Let's say $50,000. This is what you make the sales entry.
Yes, sir.
At the same time, when you are making a sales, you are removing the inventory and booking the COGS, right? So what is COGS?
Cost of goods sold.
To inventory. Let's assume this car cost you $40,000, or let's say $40,000. So this car cost you $40,000. So in your income statement, you have sales of $50,000 and you have a COGS of $40,000, right? So in your income statement, what is your gross profit? You'll be having a gross profit of sales
10,000.
minus COGS, $10,000.
Yes, sir.
Yes, sir. Yes, sir.
Yes, sir.
This $10,000 is how much? This multiply by this, sorry, divide by 40,000 COGS. So this is 25% of your COGS, right? So you are generating 25% profit on the COGS. Now in case of installment sale, this $10,000 you will be recognizing only to the extent of installment you have received during the year. Let's assume this car you have sold on installment for a period of, let's say, 3 years. And you are getting like installment of, let's assume, $2,000 per month. So let's assume at the rate of $2,000 per month for 3 years. So in year 1, how much collection you have made? Are you guys with me? How much collection you have made in year 1?
24,000.
Assuming that you sold in January.
Let's assume you have sold in January 1st. Let's say January. So how much is the collection? $24,000? $1,000, right? So now when you are making an installment sale, in that case, how you book the journal entries? First entry for the sales. So in first entry would be like this only. Account receivable, installment sale account receivable. Installment sales account receivable to installment sales. And then COGS to inventory. And then your gross profit would remain this. Right? At the year end, you need to do an adjustment entry. Adjustment entry for gross profit. So gross profit is based on the collection you have made during the year. So how much collection you have made during the year? 24,000. Are you guys with me?
Yes, sir.
And what is the total collection expected? This multiplied by 3, 72,000. Yes.
Yes.
And let's assume this 72,000 present value is 50,000. This is present value. So this 72,000 has a present value of 50,000, right? So what is the collection, present value of the collection you have made? 50,000 divided by 72,000. Multiply by 24,000, right? This much is the present value you have collected. Are you guys with me?
Yes, sir.
Right? This much of the present value you have collected. Am I going right? Or you have any doubt? So in this 24,000 EMI, you have principal of 16,067 and you have interest component of this minus this. So this 733 is your interest income. Right? Yes, no?
Yes, sir.
Yeah.
Right? So in this 667, how much is the gross profit is included? How much is the gross profit included? This multiplied by 20%. Or if I say this, right? Your gross profit on sale is 20%. So your gross profit is 3,333. Are you guys with me?
Yes, sir.
So year-end adjustment you need to make is 10,000 gross profit minus the gross profit on installment received. So this much you need to defer. Defer the gross profit. So what will be the entry for this gross profit? So you need to reverse. You need to reverse the installment sale to sales reserve. by this much amount. Does that make sense? This is exception to the general rule. Installment sales is on a collection basis. So gross profit on installment sale is being recognized on a collection basis, not on accrual basis. So this is exception to the general. Are you getting
Yes, sir.
the concept? Rajat, Mayank, Vivek?
Yes, sir.
Vivek, it's difficult.
Sir, can you please tell where the 20% that you calculated, how did you calculate that 20%?
This is simple, like gross profit divided by sales. So gross profit is 20% of the sales value.
This 3,333.
This is 20% of the collection. Whatever the total amount you have collected, that has 20% gross profit.
Okay.
That's what it is. So in the total collection, you have 20% gross profit. That you need to recognize, and the remaining balance you need to defer.
Okay, got it.
Mayank, Vivek,
Yes, sir.
Divya?
Yes.
Got it?
Yes, sir.
Okay, so now let's come here. So installment sale, recognize the gain as and when the payment are received. Right? This is exception to the general rule. Here, the profit is being recognized based on collection. Calculate first, you need to calculate the gross profit ratio. How do you calculate gross profit ratio? Sales minus cost divided by sales. This is what we have done. What is this 10,000? This 10,000 is sales minus cost. Yes.
Yeah.
You guys with me? Right?
Yes, sir.
And how we calculated GP ratio 20%? This gross profit divided by sales. Same is mentioned here. Sales minus cost divided by sales. So that's how we calculated 20%. And recognized gain is collection during the period multiplied by GP ratio, which we have done here. Collection during the year is 16,667 multiplied by the GP ratio 20%. Right? That much amount you can recognize, and remaining gross profit you need to defer. Right? So this is in case of gain. But if there is any loss, then you need to follow conservative approach and you need to book all the loss upfront. Make sense? If there is a gain, then you need to defer the gain for amount which you have not collected. But if there is a loss, in that case, you'll be booking the loss upfront. Sounds good? Mayank, Vivek, Sachin is here. Vivek, Sachin is here. No response. I think he's also not here. Okay, so let's do one more example. So this example you guys do, right? Solution is in front of you, but you need to follow the sequence and let me know, like, let everyone knows like how you're understanding. So you have sales of $1 million, you have cost of $600,000, and during the year you collected $250,000. What will be the profit recognized and what will be the deferred gain? Mayank, do you mind solving this problem? With this, you can take a help of solution, but if you can just walk through everyone how we should go in this question.
So I'm reading it right now, sir.
Sorry?
Sir, I'm seeing it right now, sir. It looks a bit.
Okay, Rajat, can you explain to everyone the solution part? What is the call of the question? What is the call of the question?
What will be
Profit recognized and deferred again.
40%
What is the call of the question?
cost remaining amount? Says what will be the profit and what will be the deferred gain?
How much profit you need to recognize and how much profit you need to defer. So how much you should recognize in current year?
So profit is 400,000.
How we have calculated this 400,000?
Sales minus cost.
Okay.
So then gross profit ratio is the gross profit upon total sales.
How much is it?
40%, and then the recognized gain comes from the collection during the whole year. And 40% we have to calculate, that will be 1 lakh, and the deferred gain will be minus from the recognized gain, which is for 1 lakh, and the gross profit minus our recognized gain will be the deferred gain.
Everyone agree?
Yeah.
Vivek, Shubham?
Yes, sir.
Yes, sir. Yes, sir.
Right. Okay. Is Sachin also with you, Vivek?
No, sir. वो थोड़ी तबीयत खराब है उनकी आज.
Okay. Okay. Cool. So next is replacement property. Gain or loss can be postponed by adjusting the basis of replacement property in place of property sale or exchange. So when you are purchasing one property and exchanging another property for the same, for example, if you have a piece of land, let's assume in California, San Jose, right, and you are moving to, let's say, Los Angeles, right? So with one real estater, you have exchanged the piece of land which you have in San Jose with the piece of land which you want to build in Los Angeles. Like in that case of scenario, if you're just exchanging without money, you can postpone the gain or loss, right? You can defer the gain or loss, and you can consider the same base as of the original asset if it's just a exchange of the asset. Postpone gain by decreasing the basis of new property, or postpone loss by increasing the base of the new replaced property. For example, if you have transferred the piece of land in San Jose for, let's say, $100,000, and in exchange of that you have acquired a piece of land in Los Angeles for $110,000, right? So this $10,000, ideally you should have recognized the gain. But in case of replacement of property, you can defer this gain. How you can defer this gain? By decreasing the base of the property. That means new property base, instead of considering 110,000, you can consider it 100,000 only, right? So that in future, if you, for example, in future you are selling that Los Angeles piece of land for 150,000. So in that case, you will be paying tax on $50,000, which is 150 minus 100,000, not 150 minus 110,000. Shall I draw this example for ease of explanation? So let's assume you are in San Jose and you are moving to LA, right? In San Jose, you have a piece of land for $100,000 and you are acquiring the replaced property of $110,000. So in this transaction, you are in gain position. Are you with me? You are in gain position. How much gain you are generating? $10,000, right? But as you are just replacing the property, you can defer this gain. This gain you can defer. How you can defer this gain? By keeping the new property base as 100,000 only. And in future, let's assume you are selling this property for $150,000, right? If you have recognized the gain here, then future gain would have been 150 minus 110, $40,000. Are you guys with me? If you have been recognized this 10,000 gain today, then in future gain would be $40,000. But if you have not recognized that gain today, then the future gain would be $50,000. That means you deferred this 10,000 gain to the future event. Make sense?
Yes, sir.
So that is under the replacement of property. Next is tax-free exchange. Are you guys getting, or you want to take a break?
Sir, is there a time limit?
Time limit for what?
Deferment of the,
No, luckily no.
like we can do it infinitely
Yes.
until we finally.
Yes. Until you sell that property. Yes.
Yeah. Okay.
Very good point. I can put this as a note here.